and welcome along to the Property Academy podcast. I'm your host, Ian McKnight.
And I'm Andrew Nicol.
And so on the show, we're talking about what could go wrong. In fact, we're actually talking about the worst possible situations that can happen in property investment. So this came from a listener of the show who said, hey, it had a podcast idea that I wanted to share with you. Could you discuss more as a thought experiment what could go terribly wrong, the most disastrous risks with property investment that would be the worst case for absolutely everyone involved? Look, I understand that this is kind of the antithesis of the topics you guys like to discuss. We like to keep things upbeat and positive most of the time, but would be really interested in hearing about, I guess, some of those tail end risks. And I thought this was a great one. So I think we've got 7 in total that we're going to go through of the worst possible things that could go wrong.
The things that will keep you awake at night after listening to this episode?
Well, I certainly hope not, because they are, generally speaking, tail end risks. They're smaller risks. But I have been, as you know, listening a lot to the Reserve Bank Governor recently, and this is because there's so much regulation going on, and I've got a secret man crush on Adrian, or the Reserve Bank Governor.
Wait till Tony Alexander hears this.
So forgive me that I quote him a lot, but there's been a lot of media coverage over some of the comments he's made that there's no free lunch. He's used this phrase in a couple of different press conferences, which is not just directed to housing. He said there's no free lunch with housing, but also with things like Sharesies. So in a recent Monetary Policy Committee press conference, he was asked about what he thought about the likes of a Sharesies or a Hatch. These are the app-based share trading platforms where you can go on and buy shares. And he says, well, of course, asset prices are increasing a lot, not just for houses, shares as well. And people need to recognise the fact that there are risks involved in all sorts of investments. And so we can't just keep buying assets and thinking they're always going to keep increasing in value. That value will fluctuate over time. And certainly, I think you've seen it, Andrew, I've seen it, that there are a lot of people investing in the likes of a Sharesies or a Hatch or a Kernel, and we just need to be aware of what these risks are. And so I think it is important to go through these thought experiments and think about what could potentially happen. Now, you take it away, Andrew. What's number 1?
So I'm going to start with asset values falling significantly. So things like natural disasters that cause the building on your property to be worthless and or the land value falls. So things like earthquakes, things like tsunamis, lightning strikes, erosion of land, global warming, anything that causes your property to be underwater. And especially when there's no insurance or appropriate risk mitigation in place. So after the Christchurch earthquakes, I remember there was an insurance company called Ansvar, and they ended up going under. And so as a result, they weren't able to pay out the full amount, and their credit rating was relatively poor, but people hadn't considered that because we never thought that the earthquake was going to happen. Or your insurance is delayed and doesn't pay out. So a friend of mine came around to my house the other day, and they are just finalising their insurance settlement 10 years on from the earthquake. So, these things do happen. It's pretty extreme in terms of the case here, but of course these are all possibilities. And what's the issue with this? Well, leverage is a double-edged sword. So you make amazing gains if your asset increases in value and you've borrowed against your house to do it, but your losses are magnified if your asset decreases in value. So it does work both ways. If you'd invested 500,000 and it increased by 10%, you made 50,000. But if it decreases by that same 10%, you lost $50,000. So if there's a natural disaster and your insurance policy is delayed, then your net worth has decreased. Temporarily, yes, but it could be for an extended period, a la those friends of mine.
And similarly, I know at the 10th anniversary of those Canterbury earthquakes, there were a group of homeowners, residents, standing outside of Vero protesting because they hadn't had a settlement. Now, I'm sure there were some complications. It sounded like there was a real lack of communication on both sides. Absolutely. In that instance.
Look, those are the extreme cases now. I think that probably I would have said at least a few years ago that if you hadn't been settled at that stage, it was probably in part because of you.
Now, another thing that could cause your asset value to fall significantly, and of course, we always say the value of your home falling significantly is the worst thing because of that leverage, that if you're borrowing a lot of money and it decreases by a small percentage amount, it is a lot of money that you're potentially losing. I want to talk about hidden gradual damage as number 2. So this is something happening to your house itself, it becoming structurally unsound, there being significant rot, it being a leaky home, something along these lines, that means that it's unoccupiable for some reason. Now, that happens for two reasons, or that's an issue for two reasons. First, if your property's unoccupiable, the value is going to go down. Secondly, if it's an investment property, you're not able to tenant it. So you might be making mortgage payments without having any rental income. That's potentially going to put you in a really tough financial position personally. Now, why might this happen? There might be some poor building practices, like we saw with leaky homes. You might have a really poor product that happens to be used, which is generally what happens. I remember in a previous episode you were talking about monolithic cladding, Andrew, and how that was a real issue that you ended up running away from, but you didn't know at the time. Something around rotting or erosion of your foundations. Coming back to what you were saying about global warming, we talked not long ago about those properties in the Waitomo district, I think it was, or South Waikato, where the land underneath the property was literally eroding to the point where eventually that property may not exist at all because it's just all going to be beachfront. So some sort of hidden gradual damage, the property becomes unoccupiable and the foundations are rotting. That would probably be the worst case scenario where the building on top of the land is more or less worthless.
Next one, again, which controls the value of your asset, is house prices just falling. So let's say there was a major recession, New Zealand went into recession, and it caused house prices to fall by 20%. So there was a major financial crisis. Now, the last GFC was between 5 and 7% losses from memory.
In some areas, it was up to 10%. But some of the COVID modelling showed up to 20, or I think in some instances, 40% drops in house values.
Yes, I remember there were newspaper articles about it at the time. You know, those extreme worst case headlines made the press. But something where all of a sudden your asset price is so much less, that can be pretty scary. And of course, in these types of times, people do often jump and crystallise those losses by selling the property to get out, because newspapers will tell them that it's going to continue.
Yeah, and just leading on from that, if that happens, something that would probably be a worst case scenario, and remember, this happened actually to Jonathan Little, which he talked about, or Johnny Little when he came on the show, which is if the bank called in a specific loan. So with some types of investment or in some types of loans, the bank can say, hey, you need to repay that now. You need to give me the money. So that would be things like a revolving credit if you're using that in order to fund the deposit for your investment property. So the benefit, of course, of using a revolving credit is it's very flexible, but the bank can call that in at any time.
And actually with commercial loans, often there'll be annual reviews on those, and so they've got the right to ask you to repay it in an annual review anyway.
So in that instance, if we saw house prices falling, or if you're a commercial property investor, the value of that property falling, the bank calls you up and says, hey, you need to pay us some money. And of course, you're probably using a revolving credit because you needed access to the cash. You probably don't have an extra spare 100K sitting over here that you can then repay that revolving credit on. If they're calling in loans, that's going to be really tough on you because where are you going to find the money from, especially if that asset is decreasing in value?
And actually, I know a large Christchurch investor who had invested quite heavily in earthquake damaged properties, and the bank then saw that as a risk, and because they fell under commercial because of the amount of lending, their bank started calling in loans as well.
And how long, when that happens, how long you got to repay that?
Not very long. She had to refinance to non-bank lenders. It was very expensive and very stressful for her. Next on my list is tenants. So let's say they cause damage to the property, and that causes your property to decrease in value. So they just trash the place, or they set up a meth lab in there or something like that. And again, what if it was intentional damage, which, yes, they're liable, but what if they can't pay it back? So if they are a meth dealer and all of a sudden they've contaminated your entire house, but they've got no regular income in which to pay you back by, well, that can be a major risk as well.
And that would be the case if they had massive parties in there, were putting holes in the walls, ripping up carpet, like this. Like, we're talking real worst case. You can imagine that, say there was 50K of damage because all the chattels had been pulled out. A tenant, very few people have 50K lying around in order to pay that back. So you might be paid back at $10 or $20 a week. And
Absolutely.
so the cash flow doesn't work in order to be able to get that property back up to the same standard.
And that's one thing to remember with some of these judgments. So, I mean, we did one where we were talking about tenants having to pay $9,000 to the landlord previously. They do still have the right to pay that over an extended period of time. They go through what's called a means testing, and they look at their income and expenses. And look, let's face it, people don't have a lot of money left over at the end of the week. And if they're renting, that's probably true as well. So, they're probably in those earlier stages of their income life. And so they might not have a lot of disposable income in which to pay you back. It could take 5 years to pay back that money.
So I want to talk about, as number 6, if you're forced to sell at an inopportune time, and this could cause you to lose quite significant amounts of money. So the first might be you've bought an investment property with your partner, and then you go through a separation or a divorce. Now, your partner or you might decide that you need to then liquidate that property. You need to sell it, whether so you can go and buy another home, or your partner might be particularly difficult and want that property liquidated for whatever reason. Now, if you have to sell in that instance, you might be selling before the bright line test is up, before that 5-year period. And of course, if the bright line is extended to 10 years, it might be within a 10-year period. Now, if that happens, you could potentially be having to pay $30,000, $40,000 worth of tax, $50,000 worth of tax, depending on how much gain that property has had over time. Whereas you might have been able to wait an extra year, wait an extra 2 years perhaps, and in that case not had to pay that tax. So you can sometimes, in some instances, selling early can have a real issue in terms of not getting the full wealth or full gain from that property that you thought you would. And then just going on from that as well, let's say you're selling at an inopportune time. If you need to sell because you're at the bottom of a property cycle, or property prices have fallen since perhaps you bought that property, or since what that property was previously worth and you could have cashed out at, that's going to be really tough as well.
Just a side note on that, the Bright Line test does have an exemption for properties that fall under a relationship property, so you can be excluded of paying tax if you are separating.
Really? I didn't know that.
Well, stick with me, kid. You'll learn a thing every day. Number 7 is cash flow. So the property becomes too cash flow poor that you need to sell the property. So perhaps interest rates have gone up and you can't afford it anymore, or it's just putting you in a bad financial position. Your tenants aren't paying the rent. The bank's forcing you to pay principal and interest due to regulation, such as the Responsible Lending Code, or actually a really interesting case with one of my investors. So they'd signed up for 3 rental properties, and then there was a change in the bank's rules prior to their settlement. So the first 2 settled on interest only. The third was changed to principal and interest. Now, the really interesting part about this story is that client fought this with the bank over a number of years, and it actually just recently got settled. They went to the banking ombudsman over this and basically said, hey, it was a bait and switch. You told us we could have interest only, and then you switched out the loan documents for principal and interest. The ombudsman awarded or the bank settled it, and they got paid out for it.
Let me just jump in there, Andrew, because I'm interested in this. I think we'll probably have to do a whole podcast on it, but they took them to the banking ombudsman. Am I right in thinking they got paid out some sort of money? So they'd already been paying down principal,
yes,
and then they got paid out again for that, which they could then use to pay down principal further.
Yeah, there were a number of things, as often as the case. Rather than one thing go wrong, like 5 things have gone wrong.
We'll do this as a separate podcast because that sounds interesting. We can talk about the process for taking somebody to the banking ombudsman, because it's not something I've ever done before.
You would be that type of guy. I've been charged $12.50 on this account.
You told me it was only going to be $11. So look, there are some pretty scary risks in here. But again, this all comes back to, and most of property, we always say, comes back to this idea of leverage. So if your property increases in value, you make an outsized gain, a magnified gain, because you're investing with a whole heap of somebody else's money, the banks in this case. But if house prices go the wrong way, and I know they have in your past, Andrew, when you've purchased property at 100% lending and then it's decreased in value. But if house prices go the wrong way in the short term and you were then forced to sell, that is really the biggest risk of all, because you're not able to then have time for the market to heal, for that property to increase in value, for prices to rebound.
And that's the thing to remember. Time heals all in property. So you just need to have good length of time in the market. If you do that, you can pretty much say with certainty that you're going to have the growth. But it's if one of these major events triggers your need to sell.
But of course, there is no free lunch. So I think that it's important that you're at least aware of these. What I would encourage you to do is not stay up all night thinking about these things, worrying about them, because they are very tail end risks. I mean, the fact of the matter is that the worst case scenario when each of us jump in a car to go to work in the morning, well, you can probably picture what the worst case scenario is. But that's,
you get there.
We still take risks. We still do things that we know could potentially go wrong because it's got a beneficial outcome. And that's what we're hoping to move towards.
And actually, I say to investors all the time who are maybe a bit conservative and worried about all the potential risks is there's one certainty. And that's if you don't do something, you're going to stay where you are. And are you happy with that? And if you're not, then you have to take some risk.
Fantastic. Let's wrap it up there. But please don't forget to rate, review, and subscribe to the podcast. Really helps us get the message out to more people. And hey, don't forget that we are doing property investment dinners around the country. This is to celebrate 1 million downloads of the Property Academy podcast. And we're very grateful to everybody who listens to the show and has helped us achieve this milestone. So we're coming to Queenstown. We're coming to Christchurch, Auckland, and Wellington, and we want to take you out for dinner. Now, of course, we can't fit everybody into the restaurant who listens to the show, so we're going to have to do a little draw. So how do you enter that? First of all, there are 3 things we want you to do. Please follow us on Instagram. We are at @opus_partners. Please share this on social media. Maybe say something that you've learned from this show. And then also please review us on Apple or wherever you listen to your podcasts. That really does help us get the message out to more people. Then take a quick screenshot of that review. Send it to podcasts@opuspartners.co.nz. And hey, not only will you be up for a free dinner and house wines.
That was my joke that he stole.
No, I made up that joke and then you've claimed it. Do that and you'll get to go out for dinner with us. Thanks for listening to the Property Academy podcast. I'm your host, Ed McKnight.
And I'm Andrew Nicholl.
And we're going to be back again tomorrow with even more daily strategies, tactics and insights to help you get the most out of the New Zealand property market. Until next time.